when you're preparing a sales budget, your sales will be given January's 20,000, February 50,000, March 30,000. So just put those numbers in here, and they total 100,000 and $10 a unit. So put your $10 here, times them out, and you've got your total, which is 1,000. So this is the total for the quarter. This would be the first quarter that we're looking at here. Okay, the next thing that we're going to look at is your budget information. And if we're going to make all of our sales on credit, then we've got to figure out exactly what month are we going to be collecting. So all sales are on credit. The company collects 70% in the month of the sale, 25% in the month following the sale, and the remaining 5% is uncollectible. So the best way to do this is take each month, the sales from each month, and determine when they are collected. So we're going to start with December sales, which were 120,000. So December sales are 120,000. If we collected 70% in December, then that means we're going to be collecting 25% in January. So 25 times 120,000 is 30,000 is what we're going to collect in January. Then the January sales were 200,000. So take the 200,000 times 70%, and that is what we're going to collect in January. And the remaining 25% we will collect in February. And again, remember this 5% we're never going to collect. So we're not going to concern ourselves on this schedule of cash collections. All right, February sales were 500,000. So 70% of those were collected in February. That's the 350. 25% were collected in March. So that's the 125,000. March sales are 300,000. So put your March sales here for 300,000 times 70% is 210. Now, that other 25% of March's sales is going to be shown as an account receivable. And we assume that we're going to write the 5% off. So we only expect to get 25% of those. So to calculate our net, so you take 0.25 times the 300,000, and that equals 75,000. And that would be what your account receivable would be at that point in time. And that's significant because when you're creating a projected balance sheet, you would need to know what your accounts receivable is projected to be. Next budget we're going to prepare is the production budget. And the production budget starts with the sales in units, and we get this from the sales budget. You can just rewrite all those numbers from the sales budget. Now, companies always want to have some ending inventory in case that they sell more than they actually think they're going to sell. And they don't want to end at the end of the period, they don't want to be flat out of inventory. So we're going to add our desired ending inventory. And it says here that the company requires a finished goods inventory on hand at the end of each month equal to 20% of the following month's budgeted sales in units. So in February, our budgeted sales are 50,000. So we would take 20% of that 50,000 And that's why we want to end up at the end of January with 10,000. So we want 10,000. And so the total units that we need are 30,000. Now, our beginning inventory would have been the same as our ending inventory from December. So let's look and see what was our desired ending inventory for December. Well, remember, we always want to have 20% of the following month's budgeted sales in units in our ending inventory. So 20% of January's 20,000 units is 4,000. So that's how I know that my beginning inventory was 4,000, because that was my ending inventory for December. And I'm going to subtract the beginning inventory because the total that I need, the total units I need for the month are 30,000, but I'm starting with 4. So all I need to make this month is 26,000. Now, the ending inventory from the previous month becomes the beginning inventory. So the ending inventory from January becomes February's beginning inventory. And the ending inventory from February becomes March's beginning inventory. So that's where you get your beginning inventory numbers. And the ending inventory, again, remember, is 20% of the next month's needs. So in March, we need 30,000. So that means we're going to need 20% or 6,000 at the end of February. So 50 plus 6 is 56 minus the 10 gives us 46. Okay, for March, where do we get our beginning inventory, or our ending inventory? It's from April's sales. And we're given some information here. The company's budgeted sales is 25,000 units for April and 15,000 units for May, but we don't need May right now. We're just going to use April. So 20% of 25,000 is 5,000, and that's shown you right here. It's the 15%, or April is April's production in units, which it's not going to show up in this budget here, but April's production in units is going to be the 25,000 from their budgeted units, plus they want to have 15%, or excuse me, 20% of the units that they'll need in May. Because remember, April is going to have its current sales plus 20% of May. So 20% of the 15 is whatever that is, 3,000. And then they would minus the ending or the beginning inventory of April is March's ending inventory. Right here, this 5,000. So we're going to come back to this 2,300,000 number in a minute. But that is what April's production is going to be. So I rewrote that here for you. I think it's easier to see it if it's in a format like this. So April's beginning inventory is 25,000. Excuse me, that's their total needs. Their desired ending inventory is 3,000. That's 20% times May's 15,000. Then you minus the 5,000. The ending inventory of March becomes beginning inventory of April. So April's total needs are 23,000. So looking at the balance sheet, if this is our finished goods inventory, 5,000 times $10, then our finished goods inventory would be 50,000. Could write a little better, 10. And that's the number that would go on our finished goods inventory for the balance sheet. Okay. Production or inventory purchases budget. My ending inventory in finished goods is $5,000. Okay. So, all right, direct material budget. That's what we're looking at here. We've got this production in units from our production budget, and so we've just copied down these numbers right from the production budget. So it says an inventory budget for a merchandising company. 5 pounds of material are required for each unit. The company requires a raw materials ending inventory equal to 10% of the following month's production needs, and the beginning raw materials inventory is 13,000 pounds. So let's look at, this is the production. So every unit requires 5 pounds. So we're just going to times that by 5. So our production needs are 130,000, 230, 145, and 505. Now the ending inventory is got to be 10% of the following month's production needs. So 10% of 230,000 pounds is 23,000 pounds. While we're on this line, let's look at this one. 10% of 145,000 pounds is 14,500. Now, how did we get our 10% of April? We need to get 10% of April's needs. From the production budget, we showed that April needed to produce 23,000 pounds, or product, 23,000 units, times 5 pounds means 115,000 pounds, times that by 10%, and April's total ending inventory, March's ending inventory is 11,500, which is 10% of what we're going to need in April. All right, so you add those two numbers together, you get your total needs. The beginning inventory was given to us, and even if it hadn't been given, remember the beginning inventory for January would be what we needed at the end of December. Well, at the end of December, we would have needed 10% of our January pounds. So 10% of 130,000 is 13,000. That number was given to you, but even if it hadn't been, you could have calculated it. So 153 is our total pounds needed for January. We're having a beginning inventory of 13,000, so we need to buy 140,000 pounds. All right, so the ending inventory of January becomes the beginning inventory of February. So we already did our whole ending inventory line. So our beginning inventory, the 23 goes to here, and the ending from February begins March's beginning inventory. So, just subtract this line. This is what you've got. Now, the key that I want to focus on is in the total column, because you can't just add all of these across, nor can you add all of your beginning inventory across, because the beginning of that quarter is January 1. So what's the beginning inventory? On January 1, your beginning inventory was 13,000, and so 13,000 goes in the total column. Your ending inventory at the end of March is 11,500, and that's at the end of the quarter. It's 11,500. So this quarter column has to make sense all by itself if it were just standing alone. And that's a common error that students make, is they add everything across, and you can't do that. Some lines you can, but not when it has to do with beginning or ending inventory. Now, as far as what will be on our balance sheet for direct materials inventory, we can calculate that because we know that my ending inventory in terms of material is going to be 11,500 pounds. So we can take 11,500 and times it by 0.40, and that equals 4,600. So that's going to be my ending inventory that will show up for direct materials that will show up on the balance sheet. So with this information, the material to be purchased, we can figure out what are going to be our cash payments for these purchases. So we've just taken the materials to be purchased and carried that down to this schedule right here. So material costs 40 cents a pound, and half of the month's purchases are paid for in the month of the purchase, while the other half is paid for in the following month. So we've got 40 cents a pound, half and half, and we owe $12,000 from December's purchases. So the accounts payable balance is what's going to have to be paid off in January. So we take the materials that we need to purchase, and that's from the previous schedule, as I had pointed out, and it's 40 cents a pound, so just times it by 40 cents, and this is the cost that you're going to get. Now, we pay for half of these in January and the other half in February. But the best thing to do is let's start back with December's. And again, it's easiest to look at the month and then schedule out when you're going to be paying. So December's purchases, we're going to be paying in January. That's $12,000. January's purchases are $56,000. Half are paid in January. The other half are paid in February. Okay, so you can see we put them in that column. February's purchases are $88,600. Half are paid in February and half are paid in March. March purchases, $56,800. Half are paid in March. And the other half are going to be paid in April. So that means at the end of the year, or the quarter, the end of March, our accounts payable is going to be $28,400. That's a pretty lame 8, but that's what it is. So then what you would do is total these across, 12, add them all across, and then add them all down. So this is a case where your total column, you can add everything across, and it's going to come out to be $185,000. And if you remember, on this budget, I had the 11,500 ending units right here, and they're each 40 cents, pounds rather, and 40 cents a pound. So my direct materials is 4,600. The direct labor budget is one of the easier budgets because it's pretty darn quick. So you start with production in units, and we got that from our production budget. So I'll just enter that across the row. Then it says that each product requires 0.5 hours or 3 minutes of direct labor to produce. And so we are going to times each one by 0.05 minutes. So total labor hours are 1,300, 2,300, 1,450. Company pays their direct laborers $10 per hour. So we just take our direct labor, $10 per hour, multiply it by the hours, and that's our total direct labor cost. this will go straight to the cash budget because our laborers don't want to wait to get paid. So they're going to be paid in cash. Manufacturing overhead budget. Now, this budget uses information from the preceding handouts, and the variable manufacturing overhead consists of variable and fixed overhead. So we've got the variable overhead is $1 per unit produced, and fixed manufacturing overhead is $5,500 a month. And the fixed manufacturing overhead includes $20,500 of depreciation, which is not a cash outflow. And that comes into account when we do our cash budget. So, start with production in units. This is about the third or fourth time we've seen this. Take that from the production budget. So you can see why you have to do these in a certain order. Because, oftentimes one budget will rely on information in an earlier budget. So the variable manufacturing rate is $1 a unit. So that's our total variable manufacturing overhead costs. Then we have fixed manufacturing overhead costs, which were given. Total those up. And again, in this case, you can total these all across. The only time that you can't total numbers across for your total column is when you've got beginning and ending inventory and beginning and ending cash. Now, this is our total manufacturing cost. We're going to subtract out the depreciation so that we can come up with our cash manufacturing overhead costs, because these numbers will flow to our cash budget. Okay, so we go to the manufacturing overhead budget, and our total overhead is $252,500, and we're going to divide that by our total production in units of 101,000. The selling and administrative expense budget is similar to the manufacturing overhead budget in that it's going to separate the costs out between fixed and variable. So, variable selling and administrative expenses are 50 cents per unit sold. And fixed selling and administrative expenses are $70,000 per month, which includes $10,000 of depreciation, which is not a cash outflow. So we start with our sales in units from our very first budget. The rate is 50 cents a unit sold. So my total variable selling and admin are these numbers here. Fixed selling and admin was given as $70,000 across the board. And that gives us our total selling and administrative of $80, $95, and $85. And then our non-cash expenses, which is the depreciation, is $10,000. And so we end up with cash payments for selling and admin. This row will end up moving to our cash budget. Now, on the total column, again, in this particular case, you can add everything across, and it works out. Of course, you can't add the 50 cents across. No, it's not like it's $1.50 here. You have to think about what you're doing when you're doing your total column. But everything else can be added across, and it works out. If you were doing a beginning or ending inventory, or cash beginning and ending balances, then you can't add stuff across. I mean, you can add some things, but not the beginning and ending inventories. So you've got your selling and administrative budget, and the total selling and administrative is $260,000. All right, now we've got the cash budget that we're going to be doing here. And let's read this information. The company has an open line of credit up to $75,000 at 16%. You can tell this is an old problem because you can get money for way less interest than that. This is what the mafia would be charging. All borrowing occurs at the beginning of the month with payments at the end of the month. The company requires at least $30,000 cash at the end of each month. So that's basically what they always want to have in their checking account. They don't want to take it down to nothing. The cash balance at the end of December is $40,000. Cash dividends of $51,000 are paid in January. Equipment purchases of $143,700 are scheduled for February, and $48,800 for March. So they're going to buy equipment in a couple of different months. The equipment will be tested during this quarter, with depreciation starting the next quarter, which will be in April. Okay, so when we start our cash budget, the way we do this is pretty much you have to do a column at a time. You can't be going all the way across. Beginning cash balance was given of $40,000. We add our cash collections from sales, which was from the sales budget. At the bottom half of that, we had our cash collections from sales. So we're going to bring the bottom line number from that budget, and so we can actually pull this all in at the same time. 170, 400, and 335. It's from our cash collections. You can go back and look at that if you have any questions about where that came from. Okay, we're going to do our total column at the end. So let's look at this. So this is our total cash available, $210,000. Now our materials purchases from the materials purchase budget are transferred across here. Our direct labor costs transferred here. Manufacturing overhead transferred here. Selling and admin transferred here. So basically we've done all these budgets and now we're just putting them. Now, two things to remember on the manufacturing overhead. This isn't the total manufacturing overhead cost. This is the cash paid for manufacturing overhead. And that's why we use the number after depreciation has been subtracted out. And we do the same for the selling and administrative budget. This is after the depreciation. This isn't the total selling and administrative. And those are two things to keep in mind. The equipment purchases were given, $143,700 in February, $48,800 in March. And then dividends are going to be paid in January. And all of these are outflows. You can write disbursements or cash outflows. So adding up just our outflows or disbursements, which also means payments, we get 230. So 210 minus 230 gives us a negative or deficiency balance of 20,000. So if we want to end the period with 30,000, we're going to need to borrow 50. So we borrow 50,000, and the financing section consists of 3 rows. And when we say total financing, we're just totaling our borrowings, repayments, and interest. And of course, there's only borrowings this period, so we have our 50,000. So we take our deficiency plus our total financing of 50 gives us an ending balance of 30,000. Okay, this 30,000 becomes our beginning balance for February. We already had our cash collections. Total cash available, 430. We've already summed all these up, so we know our total disbursements are 400,000. 430 minus 400 gives us 30,000. Perfect. That's exactly the number that we want. So there are no borrowings, repayments, or interest. So our total financing is 0. 30 plus financing is 30. Again, the ending balance of February becomes the beginning balance of March. Add the beginning balance to the cash collections, we have 365. Our disbursements total 270, 365 minus 270. Wow, March is a great quarter, or a great month. We've got 95,000. Now, do we have enough to pay back our 50,000 plus leave 30,000 plus pay interest? Yes, we do. So, in this month, we're going to have 50,000 of repayments, and we're going to repay our interest. And the way we calculate our interest is On this $50,000, we assume that we borrowed it at the beginning of January, and we're paying it back at the end of March. So that's 3 months. This 16% rate is the annual rate. So we take 50,000 times 16% times 3 months. It's 2,000. 50,000 plus 2,000. Our total financing outflow this time is 52,000. So 95 plus the total financing gives me my ending cash balance. So whatever your total financing is, you add it. In this case, it was positive, so 20, minus 20 plus 50 is 30. 95 minus 52 is 43. Now, let's look at the total column. At the beginning of the quarter, which was January 1, my cash balance was 40,000. So I put 40,000 here. I do not add these three numbers across because it doesn't make sense. I don't have 100,000 at the beginning of the quarter, which is what these add up to. I only have 40,000. I can add my cash collections across, get 905. 40 plus 905 gives me 945. All right, let's look at the total column here. The beginning of the quarter is the same day as the beginning of January, January 1. So the cash balance at the beginning of the quarter has to be 40,000. You can't add these across. It equals 100,000. That doesn't make sense. My beginning balance at the beginning of the quarter was not 100,000. It was 40,000. Now my cash collections, you can add across. 40 plus 905 gives me a total cash available for the quarter of 945. You would like to be able to have this column make sense and stand alone. So my total disbursements, all of these can be added across. So 945 minus 900,000. This is my total cash available minus the disbursements gives me 45,000 in cash. Now, the borrowing, the financing section, all of these can be added across. So then I would add my 50 minus 2 gives me total financing of 2,000. You can also check this. 50,000 minus 52 gives me a net outflow of 2,000. Remember, this is a cash budget I'm doing. So I'm saying my net cash outflow from financing is 2,000. 45 minus 2 gives me the 43,000. This makes sense because this was my ending balance at the end of March. March 31st, I had 43,000 cash, and that is the same day as the end of the quarter. So our ending cash at the end of the quarter, same as the end of March, is 43,000. We are now going to do a budgeted income statement for the quarter ending March 31st, whatever year you want to pick. So sales, 950,000 we got right here from our sales budget. Now, to calculate the cost of goods sold, we're going to take you to the next slide. I come back to my cost of goods sold of 500, and that gives me a gross margin of 450,000. Now my selling and administrative expenses are going to come from my selling and administrative budget. So that gives us a net operating income of 190,000, less our interest expense from the cash budget of 2,000, net income of 188,000. And we did a percentage here, ratio, and the way we get these numbers is every single one of these is the numerator, and the denominator is 950,000. So that's why 950,000 is 100%. So 500 divided by 950 is 52.63. 450 divided by 950 is 47. Of course, these two have to add up to 100. And it just goes all the way down the row like that. Okay, now, let's look at what would be on our balance sheet. Okay, we're not going to do a full-blown projected balance sheet, but we have these assets and liabilities that we can bring across. So our cash balance is our ending cash from our cash budget. Our accounts receivable, we figured on our cash collections balance, budget rather, and that was $75,000. It's kind of hard to read my writing. These are skinny lines. Raw materials inventory balance. I need to go to my direct materials budget. 4,600. So finished goods inventory. Let's go to my 5,000. Let's get this right. Times my cost of goods sold of $5, what I already calculated, equals 25,000. And then my accounts payable, I got that from my cash payments, and that number is 28,400. So this is just a partial balance sheet, but it gives you an idea of what a full balance sheet would look like and how to even create one. So the cost of goods sold is made up of direct materials, direct labor, and overhead. So our direct materials, for each unit, it takes 5 pounds, and we know that the cost is 40 cents a pound. So that's $2. The direct labor, it takes 0.05 hours, which is 3 minutes, times $10 an hour is what we're paying our labor. So that's 50 cents. Okay, now we've got to do overhead.